Most people will tell you that expecting more than 12 to 14% returns from stock markets is impossible. But is it? Hi guys, welcome to our YouTube channel Omega Finance, where we share with you knowledge and insights from the world of personal finance and investing. If you're someone who has just graduated and has landed their first job, or someone who has been working for a few years, chances are that you would be getting a lot of advice from family and well-wishers about savings. In India, people use the word saving and investing interchangeably, even though most people know they have different meanings. So you would have heard your father, Mamaji, or that friendly neighborhood uncle saying, "Beta, savings shuru kar do. Mutual funds में SIP start कर दो. Stock market में saving मत करना, पैसा डूब जाएगा." etc., etc. A lot of freshers who are serious about their future take that advice and start with something. It could be opening a recurring deposit with a bank or starting a monthly SIP in a mutual fund. However, after a few months or years, they realize this is not how they can create long-term wealth. Once they have that realization, they start looking for other avenues where they can generate more returns. And that's how most people finally land up at investing in stocks directly. But even here, a lot of freshers and beginners make the mistake of relying on advice, or as we say in India, tips for stock selection. Only when they've burnt their fingers by buying and selling stock based on tips do most people realize that making huge returns in the stock market is not an easy task. So is it that hard to make high returns from the stock market? Can you make 30% annual returns from the stock market? And what stocks should you invest in to get such high returns? Before we answer all those questions, we would request you to please like this video and subscribe to our channel so that we can continue making such videos and you can get the free insights we share regularly. If you've been reading about the stock market or following the financial news, you might be aware of names like Warren Buffett, George Soros, Peter Lynch, etc. Back home, you would have heard about ace investors like Rakesh Jhunjhunwala or Radhakishan Damani. All these people are investing legends that made billions of dollars only through investing. Not only them, but there are thousands of people around the world who have millions by picking the right stocks at the right time and have seen their money make more money for them year after year. If you can compound your money at an average rate of 30%, an investment of only 10,000 rupees can turn into 19 lakh in 20 years and over 2.6 crore in 30 years. There are many investors who have managed to compound their money at an annual rate of 30 or even 40% for many years. If they can do it, so can you, if you're ready to follow in the footsteps of the legendary investors. What are those footsteps, you ask? Well, we've explained them step by step in this video. Step 1. Start reading. Yes, if you want to become an ace investor who can grow their money at 30% annually, you will have to start by reading. They say that knowledge gives you power, and you cannot become knowledgeable about any topic if you don't spend time reading. So if you're a complete newbie to investing, someone who has no knowledge about business, finance, economics or accounting, our suggestion would be to start with books that are considered bestsellers in the investing world and are so easy to read that even a person with no background in finance can understand them. You can start with One Up on Wall Street, a book written by Peter Lynch, who is considered one of the best mutual fund managers of all time. Mr. Lynch ran the Magellan Fund, which between 1977 and 1990 produced an average annual return of 29.2%. You can also start by reading Market Wizards, written by Jack D. Schwager, which is considered an investment classic. Mr. Schwager has written multiple books in his Market Wizards series, in which he has interviewed many successful investors and traders who have a long track record of beating the markets. By reading his books, you will get an idea about how great investors think and the techniques they use to beat the market and generate humongous returns. Step 2. Learn how to read financial statements. Once you've read best-selling books that introduce you to the world of investing and have got an idea about how investing works, start going through the financial statements of companies. At first, all those numbers might look daunting to you. You might even feel that terms like revenue, operating expense, net income to shareholders, etc. don't make any sense. But don't give up. When we start learning a subject for the first time, any topic looks complicated. But if we don't give up and continue learning, things start making sense slowly but surely. So you will find it difficult initially, but after a few weeks, you will start understanding what revenue, cost of goods sold, operating expense, operating income, net income, and earnings per share mean. If you can now understand those terms and differentiate between things like operating expense and capital expense, bravo! Now you're ready for the balance sheet and the statements of cash flows. A balance sheet gives you a snapshot of what a company owns, what it owes, and how much capital existing owners have put into the company. The statement of cash flows in simple terms gives you an idea about a company's cash inflows and outflows during a given period. Once you can read a company's financial reports and statements, you're already ahead of 90% of the investors who invest in the stock markets. As we mentioned at the start of the video, most investors, especially new investors, make the mistake of buying and selling shares based on tips. They don't want to do the hard work. And if you want to be successful at anything in this world, including investing, you cannot succeed without hard work. Now that you can read through a financial statement and understand what those numbers mean, let's proceed to the next step. Step 3. Buy good quality companies at cheap valuation. This is where your main journey in investing begins. Up until now, whatever you learnt in steps 1 and 2 was for you to gain knowledge about how companies work and report their financial numbers. Your main task begins now when you have to select companies in which you should invest. For this, you need to build an understanding of financial ratios so you can quickly filter between good and bad companies. There are many financial ratios that financial analysts use. You don't need to know all of them, but must know some of them that are used widely. For example, you would have heard about the PE or price to earnings ratio. It is a straightforward ratio that you can calculate by dividing the earnings per share or net income per share of a company in the last 1 year by its current stock price. The PE ratio lets you know if a stock is cheap or overvalued. However, please remember there is not one PE ratio which you can set as a benchmark and based on which you can decide if a stock is cheap or expensive. Different sectors and industries may trade at different PE ratios. For example, you will find that the stocks of government banks usually trade at a low PE multiple of only 5 or 8, while stocks of IT companies or recently listed startups trade at a very high PE ratio of 30 or even above 100. The PE ratio only gives you a quick glimpse of a company's value. You can look at other ratios like price to book, price to sales, EV to EBITDA, and even price to free cash flow to get a better understanding of whether a company is trading at a cheap or an expensive valuation. Once you can differentiate between whether a stock is cheap or expensive, now you must look at the quality of a company before investing in it. But unfortunately, quality is not an objective metric you can quickly gauge. Quality is a highly subjective thing. For example, if you and your friend go to the market to buy a shoe, you will find that there will be differences in opinion between you and your friend about which shoe is of good quality and which shoe is of poor quality and is overpriced. Similarly, when researching which stocks to buy, you will often find that a company's business might look good on paper, but its management might be a fraud. You will also find many companies that are trading at very low valuation, but that could be because they're in a bad quality business or the industry they operate in might be getting disrupted by a new startup. During such times, you will have to make a subjective choice and go by your gut feeling. Remember, there are no hard and fast rules in investing. No one-size-fits-all approach works. Most investors that have made 30 or 40% returns in the market managed to do so because they could identify an opportunity before the rest of the market could see it. So you can follow in their footsteps and try to find good quality companies trading at a low price. It might be that a stock of a company is trading at a low valuation because the company is facing temporary labor issues, or it could be that a company is planning to enter a new market or sell its product in new geographies. But the market doesn't think the company will succeed. When you identify opportunities like these before other investors do, you increase your chances of investing in a stock that can be a multi-bagger in the future. If you can identify only 4 or 5 stocks that turn out to be multi-baggers in the future, you can easily achieve an average annual growth rate of 30% for your portfolio. With this, we have almost come to the end of this video. But before you skip to watch another video, here are a few more minor steps that you must know about if you want to compound your money at 30%. Diversify, but don't over-diversify. If you want to grow your money at 30%, you cannot do that by investing it randomly in 30 or 40 stocks. So always diversify by investing in 5 or 8 different stocks to be safe. But make sure that you pick only the best stocks that you think can be multi-baggers in the future and keep the number of stocks in your portfolio at or below 10. Stay consistent with your approach. Many investors who come to the market for the initial few years stick with their value investing or quality investing approach. But when that approach stops working for a few months or years, they jump to another method. Remember, there's nothing guaranteed in the stock market. Sometimes you will find that the stock of a bad company with poor management is trading at a high valuation and is going up every day. Don't get tempted during such times, because that is the easiest way to destroy your wealth. Instead, stick with one approach and follow it during all times, good or bad, and you will see that in the long run, you would have made much better returns than most investors. Don't listen to tip sellers on Twitter or TV channels. If they knew which stock would go up, they would be sharing it with you for free or charging you some small amount of money. Most of the time, such tip sellers are nothing but scammers trying to make a quick buck by fooling young and novice investors such as you. So please stay away from them. If you liked this video, please subscribe to our channel and like this video so it can reach more investors and we can put out more such content and insights regularly. Thank you.